Warren Buffett just did something he hasn't done in 60 years of investing, and it's terrifying. Berkshire Hathaway is now sitting on $380.7 billion in cash. That's not a typo. $380 billion. More cash than the GDP of entire countries. More than the market cap of Netflix, Adobe, and Salesforce combined. But here's what makes this absolutely chilling. This is the highest cash position Berkshire has ever held. Higher than before the 2008 financial crisis. Higher than before the dot-com crash. Higher than any market top in history. Before I show you exactly what Buffett knows that you don't, make sure you're subscribed to Capital Collapse. Because what I'm about to reveal isn't just about one investor's decision, it's about the single most important market signal of the decade. Warren Buffett doesn't hold cash because he's bearish. He holds cash because he's waiting. And what he's waiting for should terrify every investor watching this video. Let me show you the timeline that proves this isn't random. January 2024, Berkshire's cash position hits $167 billion. The financial media calls it conservative. Smart money management. Nothing to worry about. March 2024, it climbs to $189 billion. Still, nobody's paying attention. The S&P 500 is making new all-time highs every week. June 2024, $234 billion. Now a few analysts start asking questions. But Buffett stays silent. September 2024, $271 billion. The cash pile is growing faster than most companies' annual revenue. December 2024, $325 billion. This is no longer a defensive position. This is a war chest. And now, February 2026, $380.7 billion, the largest cash hoard in corporate history. But it gets worse. At the exact same time he's building this cash fortress, Buffett is selling everything else. In the last 8 quarters, Berkshire has been a net seller of stocks for 8 consecutive quarters. That has never happened before. Not in 2008. Not in 2000. Not even in 1987. What is he selling? His largest positions. The crown jewels of the Berkshire portfolio. Apple. He's cut his Apple position by 67%. This was his largest holding. The stock he called the best business in America. And he sold 2/3 of it. Bank of America. He's been dumping shares every single week. $10 billion worth in the last 6 months alone. This was his second largest bank holding after cutting Wells Fargo to zero. He sold all of his airline stocks, all of his pharmaceutical stocks. He's systematically exiting the market while everyone else is buying. And here's the part that should make you sit up straight. Warren Buffett doesn't sell because stocks are expensive. He sells because he can't find anything worth buying. And he can't find anything worth buying because everything is overvalued. Let me show you exactly what he's looking at. The Shiller PE ratio, the cyclically adjusted price-to-earnings ratio, currently sits at 36. That's higher than 2007, higher than 1929. The only time it was higher was the dot-com bubble peak in 2000 when it hit 44, and we all know what happened after that. The Nasdaq fell 78%. The average tech stock lost 90% of its value. Trillions of dollars evaporated. Warren Buffett lived through that crash. He watched everyone else lose their fortunes while he sat on cash. And when the smoke cleared, he bought the best companies in America for pennies on the dollar. He's doing the exact same thing right now. He's not waiting for a correction. He's waiting for a collapse. But there's something else. Something the financial media completely missed. And this is the real reason his cash position matters. Warren Buffett just retired. In December 2025, he officially handed the keys to Berkshire Hathaway to Greg Abel. After 60 years of running the company, he stepped down. Now, some people will tell you this is just a coincidence. He's 95 years old. It's time to retire. Nothing unusual about that. But Warren Buffett doesn't do coincidences. He times everything. And the fact that he chose to step down at the exact market peak, with the exact largest cash position in history, while selling everything, tells you everything you need to know. He's not retiring because he's tired. He's retiring because the work is done. The positioning is complete. The trap is set. When the crash comes, and it will come, Greg Abel will have $380 billion to deploy at Depression-era prices. He'll buy entire companies for less than their cash on hand. He'll acquire the best assets in America, while everyone else is forced to sell. This is the Buffett playbook. It's happened 4 times in his career, and it's about to happen again. Let me show you the historical pattern. 1973 to 1974. The stock market crashes 48%. Buffett sits on cash the whole way down. Then he buys the Washington Post for $10 million today. It would be worth billions if he still owned it. 1987. Black Monday. The market drops 22% in a single day. Buffett doesn't panic. He buys Coca-Cola at a 50% discount. That position has made Berkshire over $20 billion, 2000 to 2002. The dot-com crash. Tech stocks lose 78%. Buffett is completely out of tech. He's holding cash and insurance stocks. When it's over, he goes on the greatest buying spree of his career. 2008 to 2009. The financial crisis. The S&P 500 falls 57%. Banks are failing. Lehman Brothers goes bankrupt. And what does Buffett do? He provides $5 billion to Goldman Sachs, $3 billion to General Electric. He gets preferred shares paying 10% dividends, and warrants that make him billions more when the stocks recover. Every single time, the pattern is the same. Build cash, sit out the bubble, wait for the crash, buy the best assets at fire sale prices, and right now, we're at step 3. The crash is coming. He's just waiting for it. But here's what you need to understand. Warren Buffett isn't smarter than you. He doesn't have a crystal ball. He's not predicting the future. He's reading the present. And what the present is telling him is that valuations are insane. Leverage is at record highs, and the risk-reward is terrible. Let me give you the numbers he's looking at. Total U.S. stock market capitalization to GDP, the Buffett Indicator, is at 204%. The historical average is 100%. Anything over 150% is considered extremely overvalued. We're at 204%. The last time it was this high? 2021, right before stocks fell 25%. And before that? 1999, right before the dot-com crash. Corporate profit margins are at all-time highs, 15.5%. The historical average is 10%. Margins this high are unsustainable. They always mean revert. And when they do, earnings collapse. And then there's the interest rate environment. The 10-year Treasury yield is at 4.5%. That means risk-free money is paying 4.5%. For Buffett to buy a stock, it has to offer a significantly better return than that. Adjusted for risk, that means he needs to see at least 8% to 10% expected returns. But at current valuations, the expected 10-year return for the S&P 500 is 3%, maybe 4% if you're optimistic. The math doesn't work, so he's not buying. He's selling, and he's building the largest cash position in history because he knows what's coming. Now let me address the elephant in the room. Some people will say Buffett is just old and out of touch. He missed the tech boom. He doesn't understand AI. He's been wrong before. And yes, he sat out the dot-com rally. He sat out the crypto rally. He sat out the meme stock rally. And he was right every single time, because all of those were bubbles, and bubbles always pop. The people who called him out of touch in 1999 lost everything in 2000. The people who called him out of touch in 2021 lost 70% when tech crashed in 2022. Warren Buffett doesn't chase returns. He preserves capital. And right now, preservation is the only rational strategy. But here's the part that should really concern you. Buffett isn't just holding cash because he thinks stocks are expensive. He's holding cash because he thinks the entire system is fragile. Look at what Berkshire owns. Insurance companies, railroads, utilities, energy. These are the foundational assets of the economy, the things that have to keep running no matter what happens. And what is he selling? Banks, tech, consumer discretionary, the things that collapse when the economy breaks. He's not betting on a normal recession. He's positioning for a systemic reset. And there's one more clue that confirms this. Berkshire's insurance float. For those who don't know, insurance float is the money Berkshire holds from insurance premiums before it has to pay out claims. It's basically free leverage. Buffett can invest this money and keep all the returns. Right now, Berkshire's insurance float is $169 billion, and normally, Buffett invests this aggressively. He buys stocks, bonds, entire companies. The float is his secret weapon for compounding returns. But today, he's holding most of that float in cash, short-term treasury bills, the safest, most liquid assets in the world. Why? Because he expects volatility. He expects liquidity to vanish. He expects a moment when cash is the only thing that matters. And when that moment comes, he wants to be the buyer, not the seller. So what does this mean for you? It means the greatest investor of all time is telling you, in the loudest way possible, that this is not the time to be aggressive. This is the time to be defensive. Now, I'm not saying sell everything and go to cash. That's not practical for most people. But I am saying you need to adjust your positioning. Let me give you the specific strategies that align with what Buffett is doing. Strategy number 1, reduce your exposure to overvalued sectors. If Buffett is selling tech and banks, you should at least trim those positions. Take some profits, lock in gains. Strategy number 2, increase your cash position. Even if it's just 10% to 20% of your portfolio, cash is optionality. Cash lets you be greedy when others are fearful. Strategy number 3, focus on quality. If you're going to own stocks, own the ones with fortress balance sheets. Low debt, high free cash flow, pricing power. The companies that can survive anything. Strategy number 4, avoid leverage. If Buffett, with all his resources and expertise, isn't using leverage right now, why would you? Margin debt is a catastrophic risk when markets turn. Strategy number 5, be patient. The crash might not happen tomorrow. It might not happen next month, but it's coming. And when it does, you want to be ready to buy, not forced to sell. Here's the historical playbook. After every major Buffett cash-building phase, there's been a market crash within 6 to 24 months. And after every crash, Berkshire has deployed that cash at incredible returns. The 1973 buildup led to the 1974 crash and the Washington Post purchase. The 1999 buildup led to the 2000 crash and the buying spree that followed. The 2007 buildup led to the 2008 crisis and the Goldman Sachs and GE deals. We're in the buildup phase right now. The crash is next, and the opportunity comes after. But here's what separates the winners from the losers. The winners have cash when the crash happens. The losers are fully invested, fully leveraged, and forced to sell at the bottom. Warren Buffett is positioning to be the winner. The question is, are you? Now, let me give you the key dates to watch, because this isn't just about waiting forever. There are specific triggers that will start the cascade. Trigger number 1, corporate earnings deterioration. Right now, S&P 500 earnings are still growing. Barely. But they're growing. When that growth turns negative and guidance gets slashed across multiple sectors, the market will reprice violently. Trigger number 2, credit spread widening. High-yield bond spreads are currently tight, around 300 basis points. When they blow out to 600 or 800 basis points, it means the credit market is pricing in defaults. And when credit freezes, stocks follow within days. Trigger number 3, the first major corporate default. When a recognizable name, a company in the S&P 500, files for bankruptcy or defaults on its debt, the contagion begins. It breaks the illusion that the Fed will save everyone. Trigger number 4, margin debt decline. Margin debt is currently at $750 billion. When forced liquidations start, you'll see this number drop 10%, 20%, 30% in a matter of weeks. That's the capitulation signal. Watch these 4 triggers. When 2 or more happen simultaneously, the crash is imminent. And here's the final piece of evidence that Buffett knows something we don't. His recent interview comments. In his last shareholder letter, he wrote, and I quote, "We only swing at pitches we like." That's his way of saying there are no good pitches right now. The market is throwing garbage, and he's not swinging. He also said, "The stock market is there to serve you, not instruct you." Translation: don't follow the crowd. Don't buy just because everyone else is buying. Make your own decisions based on value. And finally, the most telling comment. When asked why Berkshire is holding so much cash, he said, "We'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money." Very little risk. That's the key phrase. At current valuations, there is no such thing as very little risk. Everything is risky. So he's waiting. And if the greatest capital allocator in history is waiting, maybe you should be too. Let me summarize the 3 things you need to know. Number 1, Warren Buffett has built the largest cash position in history, $380.7 billion. This is not a coincidence. It's a signal. Number 2, he's been a net seller for 8 consecutive quarters while cutting his largest positions. Apple down 67%, Bank of America being dumped weekly. This is not portfolio rebalancing. This is exiting the market. Number 3, every time Buffett has done this before, a major crash followed within 6 to 24 months, and every time he deployed that cash at historic returns. The pattern is repeating right now. The crash is coming. The only question is when. And the only question that matters for you is, will you be ready? I've given you the data, the historical precedent, the specific triggers to watch, the strategies to implement. Now it's on you to act. Don't wait for CNBC to tell you the crash has started. By then, it's too late. Position yourself now while you still can. If you found this analysis valuable, subscribe to Capital Collapse, share this with someone who needs to see it, and hit that notification bell. I'll be tracking Buffett's cash position monthly with updates. Remember, the goal isn't to predict the crash. The goal is to be positioned like Buffett when it happens. Thanks for watching.